Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Christine Johnson, Head of Fixed Income for Old Mutual Global Investors. Hello, Christine.
Hi.
So what's just happened? The ECB has announced that it's going to have even lower rates in Europe.
I think what we've got to actually take from this is that the ECB has remembered what we maybe forgot about central banks, which is the element of surprise. And you can see that in how markets have reacted. Everybody was thinking they're going to do more sovereign bond purchases and they're going to cut rates further than they actually did. And of course, Mario Draghi also made this comment about whether or not there was a need to do any more. So if that was the world people were expecting, you would have expected the euro to fall and of course, sovereign bonds to rally. And you had exactly the opposite. What he's done instead is he's actually refocused the central bank and said, we're no longer running monetary policy for financial markets. What we're going to start focusing on is how we can actually get this to work for the real economy.
Which is, of course, him actually following through on what he promised all those years ago to do whatever it takes to boost the economy.
Exactly. He knows that Europe is a bank-driven economy. You've got to get the lending channel working, and that's exactly what he's taken the focus away from financial markets and said, we need to get banks lending.
And that's all well and good for the economy, that's all well and good for the financial sector, but what does that mean for bond investors?
Well, there's been a bit of giving with one hand and taking away with the other. If you're a sovereign bond investor, you're probably a little bit disappointed. Yes, the programme's got bigger, but he's also introduced another asset class in that he's now willing to buy corporate bonds. So you've kind of had the sovereign bond story fade and you've had them sell off, but you've had corporate bonds, and this morning you can't get hold of them for love or money. People really, really want anything which is investment grade in euros because you've suddenly got a big price insensitive buyer in the market.
Now, that's what's happening in Europe, but of course you're a global bond investor and in fact across all asset classes. And so looking at the world as a whole, we still seem to have this sort of two-speed bond market. You've got Japan and Europe lowering rates, you've got the US raising rates, the UK potentially will be raising rates sometime in the next year. How does this affect the way that you run a bond portfolio?
Well, it's certainly interesting times with the good and the bad bits of that. I think it matters still, though, in that nevertheless, you have got Japan and you have got Europe having negative deposit rates and continuing to pursue, even if it's on a lesser level, continuing to pursue that policy. You've also got a global money market. If you are a bank in Europe, you can decide whether or not you want to buy a Bund, which will have a negative yield on it, or if you want to buy a US Treasury. So there will be kind of segmentation where what's going on in monetary policy may not necessarily be reflected further out in terms of the bond market. The carry trade is still alive, and if I can buy a US Treasury paying me 2 and something compared to a European bond paying me a negative yield, then as a relative value trade, I'm probably still going to be interested in those US Treasuries. Because
looking at total return, you've now got a place where prices are rallying in one part of the world, but yields are looking attractive in another.
Exactly, and it just caps that gap. It just means it's very hard for US monetary policy to kind of escape and go completely on its own track, because you've always got this feedback loop going on around the world where it's the Bank of Japan or the ECB or private investors are still trying to use that relative value and to actually hold on to where you can get a positive yield.
Christine, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.